All right, let's jump right into it. 27. Yep, 27 out of 100. Now, you might be wondering what that means. Well, despite some recent price bounces that might have you thinking the bulls are completely back in charge, the Fear and Greed Index is actually sitting deeply in fear. The raw emotion driving the market right now is caution. People are scared, they're hesitant, and everyone's kind of just holding their breath to see what happens next.
And honestly, the data brilliantly illustrates why that fear exists. If you picture today's crypto landscape like some high-octane anime battle scene, complete with vibrant, comic book-style clashes of shifting momentum, you really get a sense of the chaos. On one side, we have 157 tokens rising, fighting incredibly hard to gain ground. But on the flip side, the bears are currently holding a clear numerical advantage, with 233 tokens falling into the red. It's a fierce clash, and it shows us that the overall market right now remains incredibly fragile.
Welcome to The Explainer. I'm thrilled you're here today because we have a massive, high-energy breakdown for you. The fundamental rules of the digital asset market are literally being rewritten right before our eyes today, July 7, 2026. This isn't just your standard market update. We are talking about a true paradigm shift. So let's move to the first major battlefield and see how this is all building up.
Section 1. The Fragile Recovery and Bitcoin's Leverage Trap.
Okay, so Bitcoin has made this really cautious rebound, fighting its way back up to the $63,000 to $64,000 range. But here's the catch. This recovery is fueled by a very tense, precarious mix of institutional demand and high-stakes derivatives. Just consider the sheer difference in scale here. On one hand, we've got $266 million in positive spot ETF inflows, largely led by BlackRock's IBIT. That's great, right? It provides a much-needed demand floor. But then, spot trading volume is hovering around a pretty subdued $5 billion, while futures volume is towering over the whole thing at a staggering $81.2 billion. The real, physical demand is just being completely overshadowed by massive speculative futures trading.
Which brings us to this absolutely staggering number, $46.7 billion. That is the massive open interest in Bitcoin futures right now. Basically, it means there are tens of billions of dollars tied up in leveraged bets on Bitcoin's price. This isn't just a fun statistic to throw around, it's a ticking clock. It sets up an impending danger for anyone who gets caught off guard in the crossfire.
So the crucial point here is understanding the specific risk this creates, the dreaded leverage trap. A leverage trap, or liquidity wick, happens when prices rise quickly. Not from genuine organic demand, but because futures traders are forced to buy back their short positions. And once that forced buying stops, poof, the support vanishes and the price crashes. Why does this matter to us? Because if Bitcoin cannot decisively hold that $64,000 to $66,000 resistance zone, we could easily see one of these vicious leverage traps trigger a very sharp, punishing drop.
Section 2. The never sell model shatters. Now, we are witnessing a monumental breaking of the established crypto rules by one of the market's absolute biggest whales. The old dogmas, they're dying. Listen to this, because it kind of changes everything. Strategy, the company formerly known as MicroStrategy, just sold 3,588 Bitcoin worth around $216 million. For years, their whole mentality was to lock away Bitcoin forever. Diamond hands, right? But this sale completely shatters that historic model. It signals that even the most hardcore corporate believers are now willing to treat Bitcoin as a flexible liquidity source, rather than just a vault that's locked forever.
This new corporate reality really unfolds in 3 distinct steps. Step 1 was the old way. Hold Bitcoin purely as a long-term reserve. But Step 2 brings in the harsh realities of traditional finance. Companies face debt or dividend pressure in a tight economy, which naturally leads to Step 3, utilizing that Bitcoin as flexible liquidity. This signals a serious market maturation. We might now see companies intermittently selling their Bitcoin during local peaks just to manage traditional financial obligations. The game has totally changed.
Moving on to Section 3. Rewriting the rules with regulatory tailwinds.
We're entering a fascinating new regulatory battleground. Governments aren't just fighting crypto anymore. They are suddenly pivoting to embrace and structure institutional adoption. Take the U.S. Securities and Exchange Commission's priorities for 2026 under Chairman Paul Atkins. The agenda is genuinely aggressive. They're explicitly aiming to make the U.S. the crypto capital of the world, advancing compliance, promoting tokenized securities, and clarifying capital raising rules. These are sweeping, structural regulatory changes intended to bring crypto products onshore and provide clear rules of the road.
And hey, this momentum isn't just happening in the US, it's a massive global shift.
Ripple has just achieved full regulatory compliance under the MiCA framework across the entire 30-nation European Economic Area. Now, what's really fascinating here is that despite this massive long-term bullish catalyst, which significantly reduces regulatory ambiguity, Ripple's XRP price still remains temporarily tethered to Bitcoin's current volatility. So the infrastructure is winning the war, even if the price hasn't totally decoupled just yet.
Section 4. The rise of real-world assets.
This newfound regulatory clarity is directly paving the way for the dawn of what's being called the summer of DeFi 2.0. And unlike the past, this one is driven by functional utility rather than pure, unchecked speculation. Get a load of this figure: $295 million. That is the exact amount of New York Stock Exchange-listed stock that the company securitized just successfully tokenized directly onto the Solana network. This isn't just theoretical anymore, folks. Traditional finance is physically moving its assets on-chain.
And if we trace this timeline, we can see exactly how this utility is driving real market value. Back in Q2 of 2026, Solana was processing over 1 billion weekly non-vote transactions. By early July, tokenized asset quarterly volume hit an all-time high of $5.77 billion. And the result today, July 7th, Solana's price surged past $81. This relentless utility-driven on-chain activity has made Solana a preferred institutional bet, showing incredible relative strength against a generally cautious broader market. Of course, we absolutely can't talk about utility without mentioning stablecoins. Consider Tether's recent $20 million investment in Mercado Bitcoin to fuel their Latin American expansion. Stablecoins are rapidly maturing way beyond just being tools for crypto traders to park their cash. They're actively becoming the foundational financial infrastructure for global banking and cross-border settlements. It's a real game changer.
Section 5. Decentralized vulnerabilities.
Now, as much as we'd love to say it's all smooth sailing, we need a reality check. Despite all this high-level institutional adoption and regulatory progress, the decentralized front lines remain an incredibly perilous place. Just look at this shocking recent incident. The target was the BonkDAO treasury. The method? A malicious governance proposal that somehow slipped right through the cracks. The result was a devastating loss of $20 million in Bonk tokens being drained, causing the token itself to crash by over 9%. Hacks exactly like this serve as a stark, glaring reminder of the inherent security risks in decentralized governance. It's keeping retail investors extremely wary, even as the big institutional infrastructure matures.
So I want to leave you with this final provocative thought. On one hand, Wall Street's infrastructure is arriving, and the regulatory rules are being completely rewritten. But on the other hand, the inherent dangers of the crypto Wild West, like that $20 million BonkDAO hack, are still very, very real. So the crucial question for all of us is this fragile, leverage-heavy market truly ready for its next bull run, or are we just walking blindly into a trap? Definitely something to think about. Thanks for joining me, and I'll catch you in the next explainer.